Welcome to the Deep Dive. Today we're tackling the Q2 2025 earnings call for Cable One, that's ticker CABO, and we're going to try and boil it down to the clearest, most actionable takeaways for you.
Yeah, and that's especially important this time around. Because, look, if you just glanced at the headlines, you probably saw a truly massive, frankly terrifying loss number.
Right.
So our goal here is really to cut through that noise, understand the accounting, and figure out what the actual operational story is. Where's the business really heading?
Okay, so let's dive right in with that big splash. The company reported a GAAP earnings per share loss of negative $77.70 for the quarter.
Yeah.
I mean, that is just an absolute monster of a negative figure. It's the kind of number that usually sends investors scrambling.
And, well, this is exactly why context is absolutely crucial. That staggering figure, it was driven almost entirely by a non-cash one-time impairment charge. We're talking $586 million total.
So it's an accounting thing, not actual cash flying at the door.
Precisely. It's a write-down on paper, not a sudden operational collapse costing them cash.
Okay, so where did that specific charge originate?
Most of it, about $497.2 million, was tied to their franchise agreements. The rest, around $88.8 million, was linked to goodwill. Now, management was very explicit about this on the call.
What did they say?
They framed it as being triggered by the drop in their share price, which basically forced them to reevaluate the carrying value of these assets on their books.
Right, an accounting rule kicks in.
Exactly. And they really hammered the point home that this has zero impact on their actual day-to-day strategy or, crucially, their ability to renew those franchise agreements down the line. It's essentially an accounting cleanup designed to clear the slate, put it behind them.
Okay, that's a really important distinction. So if we kind of strip out that accounting noise, what did the core operational numbers look like?
Right. Revenue for the quarter landed at $381.1 million. Now, that was down 3.4% compared to last year, but it was pretty much in line with what analysts were expecting. No big surprise there.
And profitability.
This is the key part. Adjusted EBITDA came in strong at $203.2 million. And that translates to an incredibly robust margin of 53.3%.
Wow, 53% in the sector. That's a really phenomenal margin.
It absolutely is. And when you look at cash generation, that efficiency really shines. Cash from operations was $144.9 million.
Okay.
Which then leads to an adjusted EBITDA minus CapEx. Our favorite proxy for free cash flow of $134.8 million for the quarter.
So despite the headline loss, the underlying cash engine is still humming along nicely.
That's exactly it. That consistent, significant cash generation is really the heart of the story here. Yeah. And it's what allows them to focus so heavily on paying down debt, which we'll get to.
Perfect. Let's drill into those operations then, starting with the core business. Residential broadband, revenue there was down just slightly year over year, about 0.5%. But interestingly, it saw a sequential increase quarter over quarter of 1.9%.
Right.
That suggests they still have some pricing power, doesn't it?
It does, yeah. That sequential bump came entirely from higher ARPO, average revenue per user. So they're successfully getting more revenue per customer, probably through price adjustments or rolling people off older, cheaper promotional deals.
But there's always a trade-off, isn't there? What about customer numbers?
Exactly. The trade-off was on the subscriber side. Residential data customers actually declined by 13,000 in the quarter.
Okay, 13,000 loss. And I assume the drivers are the usual suspects. Competition, churn.
Pretty much. Continued competitive pressure, definitely both fiber and fixed wireless. They also specifically called out elevated churn because they had double the typical number of customers rolling off promotional pricing. And, some seasonal softness like in college markets.
But management did point to something positive internally, right? Didn't they mention sequential growth in connects month over month?
They did, yeah. Throughout the first half of the year, they highlighted that as a sign, their newer strategies might be starting to work.
What strategies are those?
Things like simplified pricing models, trying to make offers clearer, and more segmented marketing aimed at specific customer groups. They believe this is reducing friction and helping bring new customers in the door.
But I guess the question is, are a few months of better connects enough to really turn the tide against that higher churn and the intense competition? Is it a real inflection or just maybe some noise in the data?
Well, that's precisely the right question. Management is obviously betting it's an inflection point starting. They think the churn from those promo roll-offs will normalize. But you're right to be a bit skeptical the underlying competitive pressure isn't going away. In fact, it seems to be increasing.
Okay, let's touch on the other parts of the business briefly. Business services, how did that look?
Business data revenue actually ticked up 1.2% year over year. They noted particular strength in their higher value fiber and carrier segments.
And that's strategically important, right? Even if it's smaller than residential.
Oh, definitely. While the residential side is in this fierce battle, the business segment, especially those fiber connections for enterprises and other carriers, offers a much more stable, high-margin revenue stream. It acts as a bit of a buffer.
A buffer against what?
Primarily against the ongoing decline from winding down their old legacy video product. That alone was a $9 million drag on total revenue compared to last year. So, yeah, the business segment is kind of the unsung hero, providing some steady ground while they fight the consumer battle.
Right. Now, let's go back to that consumer battle. The update on the competitive landscape was, well, pretty sobering. Fiber to the home overbuilds now cover roughly 53% of their total passings.
Yeah, up from 50% just last quarter. So the fiber challenge is definitely intensifying.
But there was an interesting nuance in what management said, wasn't there, about where the losses are really coming from?
Yes, absolutely fascinating. They made a point to differentiate. They said the primary source of their subscriber losses right now is actually coming from cell phone internet competition. Yeah. Fixed wireless access, or FWA.
Not the fiber overbuilders.
Not primarily, according to them. They're saying FWA is hurting them more right now.
Why is that distinction so critical?
Well, it changes the nature of the fight, you know. Fiber builds are heavy infrastructure projects, often targeting denser, maybe more profitable areas first. FWA, on the other hand, leveraging existing cell towers, is practically everywhere in their footprint now.
So it's a broader threat.
Exactly. Yeah. It's often cheaper, super easy for the customer to set up, and it's good enough for people who don't need blazing gigabit speeds. So it puts pressure on their lower and mid-tier service offerings in a way that fiber typically pressures the high end.
Ah, okay. So that understanding must be driving some of their new strategies, like focusing on retention and packaging.
Absolutely. Which brings us back to financial discipline. If they're not expecting customer growth near term, managing the balance sheet becomes paramount. How's that looking?
They seem very focused here. They paid down a net $70.8 million of debt in Q2, and then they repaid another $25 million on their revolver just after the quarter ended in July.
That's pretty aggressive deleveraging. And what about the cost of the remaining debt? Rates are up everywhere.
Yeah, but their weighted average cost of debt, the WACD, is remarkably low at just 3.9%.
Wow, 3.9% in this environment. That's really impressive.
It is. And holding that low cost while actively reducing the principal is a powerful combination. Plus, they stress they still have plenty of financial flexibility, about $1.02 billion in available liquidity through their revolver.
Okay, so they have firepower if needed.
And one more thing on the financial side, don't forget taxes. Thanks to a recent tax bill, they're expecting significant cash tax savings, something like $40 million this year in 2025, and potentially $120 million in total through 2027.
Right. Those tax savings are a nice added boost to the cash flow story.
So pulling it together, it really sounds like that debt reduction narrative, backed by the strong free cash flow and those tax savings, completely overshadowed that initial scary JAP loss.
I think that's fair to say. Management seems to have successfully framed that $586 million impairment as, a non-event from a cash perspective, something that's now in the rearview mirror.
Allowing investors to refocus on the cash flow and the deleveraging.
Exactly. The narrative shifted from, asset value problems to, okay, this is a cash machine, and they're laser focused on paying down debt and reducing risk.
Okay, so if stabilization, not necessarily growth, is the immediate goal, what's the outlook they provided? And what are these tactical initiatives meant to achieve? What does this all mean for the rest of the year?
Well, the forward outlook was, as you expect, pretty tempered. Management basically guided for total residential broadband revenue for the full year 2025 to be somewhere between flat and modestly down.
Flat to modestly down. And customer numbers.
They were very clear. They do not expect to grow the total number of residential broadband customers in 2025. So yes, it's very much a stabilization year focus.
But they're not just sitting back and waiting, are they? They highlighted 3 specific initiatives, these enablement platforms.
Correct. The first is on the infrastructure side. They finally completed the last phase of their billing system migration. This means all the companies they've acquired over the years are now on one single unified platform.
Why is that such a big deal?
It's huge for efficiency and agility. It lets them streamline rates, manage promotions better, and respond to competitive moves much faster. Plus, they expect it to generate several $1 million in annual cost savings starting late this year.
Okay. Makes sense. What was number two? The mobile pilot.
Yes, the mobile pilot. They've launched mobile service in a few select markets. It's under an MVNE agreement that stands for a Mobile Virtual Network Enabler.
Meaning they don't own the cell network, they resell someone else's.
Exactly. They use a major carrier's network but sell it under their own brand. The goal here isn't really to become a huge mobile player. It's purely strategic. It's about increasing customer lifetime value, reducing churn, especially against that FWA competition, and creating opportunities to bundle services. It's a retention tool.
Got it. A defensive move almost. And the third initiative involved AI.
Yeah, they talked about implementing Ask Tommy. This is an AI-powered assistant, but it's not for customers directly. It's for their internal teams, field technicians, and customer service reps.
How would that work?
So, imagine a technician is out in the field facing a tricky network issue. They can use Ask Tommy to quickly get diagnostic help, pull up relevant historical data, or find best practice solutions. The aim is purely operational efficiency, cutting down on repeat visits, fixing things faster the first time. It's a practical, sort of behind-the-scenes application of AI.
Interesting. So billing system, mobile pilot, internal AI, lots of moving parts. How did the market react to all this complexity, especially after that headline loss?
Well, the market reaction really tells the story, doesn't it? Despite that awful-looking GAAP number, the stock actually jumped 6.9% the day after the earnings call.
Okay, that's a pretty strong vote of confidence in the narrative they presented.
It really is. And if you zoom out a bit, the company's total return since that earnings release has been quite strong. We're talking shares up around 23.5%.
Wow. How does that compare to the broader sector?
It significantly outperforms. The main communication services ETF, XLC, was up about 6.4% over that same period.
So what does that divergence tell you?
To me, it suggests a couple of things. First, the market really did buy the idea that the impairment charge cleared the decks. It was seen as a positive, removing an overhang. Second, it looks like value investors, and perhaps some short covering, stepped in pretty firmly. They seem to believe that the free cash flow generation and the debt paydown story provide a solid valuation floor, even with those competitive headwinds.
So the focus now really shifts squarely onto execution, doesn't it? Can they actually maintain that ARPO, that revenue per user, while keeping churn in check with things like the mobile pilot? And can they keep hitting those debt reduction targets?
It is absolutely an execution story from here on out, 100%.
All right, that brings us to our favorite segment, where we dive into some potentially outrageous but plausible trade ideas based on everything we've just discussed.
And let's hit the disclaimer hard here. This segment is purely for entertainment and education. These are just ideas, perhaps provocative ones. We are absolutely not financial advisors, and you must do your own research and due diligence before considering any investment.
Absolutely. Okay, disclaimer delivered. So, given this backdrop, the big re-rating after the impairment, the aggressive debt paydown, these new strategic platforms starting up, how might someone think about playing the execution risk here? The stock's had a good run, suggesting maybe the floor is in, but those competitive pressures, 53% fiber overlap, ubiquitous FWA, they aren't going away.
Okay, so the pitch here leans towards taking a long position, but framing it very specifically. The argument is that the market has fundamentally re-rated Cable One. It's not being treated like a growth stock anymore, but more as a high SCF deleveraging play.
Right, a cash flow stock.
Exactly. The outrageous but plausible part comes in how you structure it to capitalize on the current momentum while defining your risk. The core bet is that the impairment really did mark a bottom, and the ongoing debt reduction provides a sort of continuous uplift or support for the stock price.
So how do you structure that trade?
Well, one way to think about it, to maybe manage the risk and potentially enhance the return, is to consider selling some long-dated, out-of-the-money put options against a long stock position.
Okay, walk us through that quickly. Selling puts, what does that achieve?
Right. So by selling put options that expire maybe, say, 12 or 18 months from now, with a strike price below the current stock price, you collect cash premium upfront.
Okay, and get paid now.
Yes. That premium effectively lowers your cost basis on the shares you already own or plan to buy. You're essentially betting that the stock price won't fall below that lower strike price by the time the option expires.
And if it doesn't fall that far?
If it stays above the strike, the puts expire worthless, you keep the entire premium you collected, and that boosts your overall return on the long stock position.
But what if it does fall below the strike? That's the risk, right?
That's the risk. If the stock price is below the strike price at expiration, you're obligated to buy more shares at that strike price, which is lower than today's price, but potentially higher than the market price at that future date. However, since the core thesis here is that the operational bottom is in and the deleveraging provides a strong floor, taking on that obligation to potentially buy more shares at a lower price might be seen as a strategically acceptable risk. You're getting paid upfront via the premium to potentially acquire more of a company you already believe in at a discount to today's price.
So it's a way to potentially lower your entry cost or enhance returns, betting on time and management hitting those milestones like the mobile rollout and the billing savings by 2026.
Precisely. It's a value-oriented approach, leaning into the deleveraging narrative and betting that management executes effectively over the next year or two, despite the competitive landscape.
Okay, interesting idea. So let's summarize our deep dive today. That huge, jaw-dropping GAAP loss, mostly a non-cash accounting distraction. It actually cleared the path for a stronger operational narrative to emerge.
Right. The company's still generating massive free cash flow, boasts industry-leading margins, and management seems laser-focused on two things: paying down debt aggressively and executing tactically with new platforms, like that mobile pilot, to combat the FWA threat and stabilize the core broadband business.
Which leads us directly to the final provocative thought we want to leave you, the listener, with today.
Given that fiber overlap is now north of 50%, and that cell phone internet, FWA, is basically everywhere, how much debt reduction is actually needed? How many hundreds of millions of dollars need to come off the balance sheet before the market truly accepts flat subscriber performance, not as a failure, but as a strategic victory in this environment?
That's the core challenge, isn't it? At what point, what debt to EBITDA ratio, perhaps, does this undeniable cash flow machine become compellingly valuable, even if they never really grow their subscriber base again?
Something to really mull over if you're looking at this company long term.
Indeed. That's the ultimate question. We really appreciate you joining us for this in-depth look at Cable One's latest quarter.